everyone, and welcome back to another episode of Let's Talk Real. I'm your host, Ysmaine, with Next Home Dream Seekers Realty, and I'm so excited because we are finally back. It's been a little bit of a while since we've been live, and now I have the honor to be co-hosting with Carlos. Carlos, how are you?
Good. Thank you for having me. Thanks for the invite.
Yeah, thank you so much for being here with us. I'm very excited to have your expertise here and explore everything real estate, especially on the financing world. But please introduce yourself and tell our audience a little bit more about you and your experience and everything.
Yeah. So my name is Carlos Wejebe. I work for My City Lending. I do loans in every state. I've been in lending for going on 6 years now. I've been in finance for like 15 years now.
Time.
Yeah. I started in banking, and then I did some investments. I had my life insurance and my Series 6 and 63 license. I know a little bit about the automobile industry financing. I worked in the automobile industry for a little bit.
Oh wow!
Yeah, and then I also worked at where was it? I worked at T-Mobile for a little bit, so I know all about like aspect of technology and all that fun stuff.
So you are like very well rounded when it comes to.
I am. I know a little bit about a lot of stuff to be dangerous.
That's why you're here to share a little bit of that with the world. So I'm very excited.
Absolutely.
Today, to get started with our first episode back, and again, I'm super excited to be back. We're going to be talking about the do's and don'ts of, and oh my goodness, I misspelled it. So do's and don'ts of home loans. So here, before we get into it, you guys remember that we always have our myth of the day. And since we are here introducing our new loan officer, mortgage advisor, I would like him to kind of explore a little bit about this very common myth, which it is that you need to have 20% down payment to buy a house. And that is not true. And I'll let you take it away.
Yes, so there are definitely a lot of different programs available right now. There are programs that will allow you to go in and finance 100%, which means 0% down. You can do 1% down, 3% down, 5% down, depending on whether you're going to live in the property or not, and what your situation is. There's different kinds of programs available that will allow you to do it with less than 20% down.
Perfect. And that is so true. And I think we have explored some of those, and I'm excited to maybe do a couple of different episodes to dig a little deeper into those different programs and programs that you may offer at your company, so we can let the audience know that there are so many different options available, and you do not need to have 20% down plus closing costs in order to buy. I mean, that is the ideal scenario for someone, but that is not the only option. So
yeah. And it's not also, and it's also not always the best option either. Even though you have the 20%, you don't like it. It depends on your situation. Not everybody's best option is to put that money down. There are other options that you can do with the difference, that could, benefit you and your family better at the end of the day. Very true.
Yes, so let's get right into it. I'm going to put the right title here. Now correct it. The don'ts of home loans. So we're going to start with the do's, the stuff that you should be doing it, and we should be exploring a little bit more and people understand what they are. So the first one is that when you get pre-approved, you should be getting a pre-approval and not a pre-qualification, right? And there's a huge on that. So Carlos, can you kind of break that down for us?
Yeah, so a pre-qual is when the bank doesn't really look at everything that you actually have. They only look at like the very top of your situation. On a pre-approval, we'll look at your credit, we'll look at your employment history, we'll look at the bank statement. We'll do a full check so that when you're ready to when you go out there and you put in an offer and you go under contract, that, you're able to go straight into underwriting because we've already pre-approved you essentially.
Exactly. Yeah. So there's a lot more paperwork. There's a lot more checks and balances that are done when you're doing a pre-approval in comparison to a pre-qual, which from my understanding is usually like more like a verbal, how much you make, what are your debts. It's very
Yeah.
like superficial.
Where's your credit? Oh, I have an 800 credit score.
Exactly. We can say whatever. I mean, of course, some people will be honest and say the right things, but it still is not going to discover all that is to discover behind the scenes. Because as you know, there's always something that you didn't know that goes beyond just how much you make, how much you owe, right? There's other things that could impact your ability to pre-approve behind your credit scores, behind child support, whatever it be. Like, there's so many different things.
Right. And not even like, I mean, yes, that's true. All of that you're saying is absolutely true. But, the other thing is like, there's some people that will actually qualify for more than they're willing to pay, because people have a certain style of life, quality of life. You know what I mean? Like some people like to go and eat a steak dinner every Friday, and if you go and you max out your pre-approval just because you can pay it, well, now, those things in life that you enjoy, you're not going to be able to. So that's part of what we do also. It's not only just, what's on the credit, but, like, what are you comfortable with? You know what I mean? Like, what budget are you looking like? What's something that you think you can handle and maintain your quality of life? Because, yes, at the end of the day, being a homeowner is great and all of that, but I want to make sure that it doesn't change your, the way you live just because you have a more expensive home.
Yeah, you can be house rich and life poor. You want to have a balance.
That's perfect. Thank you.
You want to have a balance. The house should be a complement to your lifestyle, but not necessarily take away of the things that matter the most, right? So
Agreed.
Definitely put there. Okay, so that's the first one. So make sure you're getting a pre-approval, not a pre-qualification, because it is different. And also on my side as a realtor and broker, you do need to have a pre-approval in order to put an offer on a property. Pre-qualifications are not accepted. So you do have to have an actual pre-approval. And we will check on that when you are the seller and the seller's agent will check on those information. So just
correct.
Our next one is check and improve your credit score when you want to get started. So definitely that's a do. You definitely want to work on that before you are intending to purchase a home, and the earlier the better, right?
Right. So the first thing we do, like when we talk to a client, we'll do the pre-screen. We'll kind of get an idea of a basic idea of where they're going to stand, what's going to work, what's not going to work for them. And then, we'll send them the application. They'll fill out the application, they'll upload all the documents, and, we'll take a look at the credit. And sometimes there's, little things that you can make some tweaks to that will make some very big changes to your credit. So, I don't do credit repair, just to put it out there. Yes, we do have some systems that we analyze your credit and see how we can optimize it, with what you have.
Exactly. And one thing that I always, when I do my buyer consultations and I tell my clients when they're just getting started, very initial steps, is that talking to a mortgage advisor ahead of time, even if you're not ready to do a pre-approval application yet, but talking to someone like yourself ahead of time will be super helpful to them because of that, because you can take a look ahead, see where they stand with their credit, and even give some tips and tools of how they can get there quicker or where they need to be. And it kind of, again, no credit repair services, disclosure, but we can give you guidance, right? So that's why it's so important to have this done ahead of time.
Yeah, absolutely. Whenever, a client comes to me, I'm never going to tell them no. I'm just going to tell them not yet. You need to do this in order to be able to buy. It's not going to be like, oh, no, you don't qualify. Like it's always just like, okay, like we need to work on this. And if my analytics can't get it done, then I'll send them to credit repair. Credit repair will send me a monthly updates of how they're doing and when they're going to be ready. And when they're ready, then, we're ready to go.
Yeah, exactly. So that's a second do. You should definitely work on your credit and work with someone ahead of time to assist you with the right steps to get there quicker. The third one is to work with a trusted loan officer and a trusted realtor broker, right? So that is a definite must. Like I said, usually I do my buyer consultation. That's the very first like stepping stone on the home buying process as a whole. So definitely connect with someone like myself to get started and understand the buying process. And then if they are good and they have good connections, they will maybe connect you with a good loan officer like Carlos. And then you guys can work on getting started on prepping to purchase with the credit and all that. So the initial meeting that we have with a loan officer and a realtor, it's very, very important, on the beginning of your journey. Even if you are 6 months to a year, or even 2 years from, getting ready to buy, just getting ahead of the ball and knowing what to do first. It's essential to your success and to be in the best position to buy, I would say.
Yeah, absolutely. The only thing I would add to that, I agree with everything you're saying, and the only thing I would add to that is that it's very important to meet with the realtor and with the lender, just because you don't want to be looking at a house that you're not going to qualify for. The biggest thing people do is they go on, some websites that say, oh, your monthly payment is going to be, $1,200 a month. But what it doesn't say, well, it does say, but in very small letters that people don't read, is that, you have to put 20% down and you have to get this rate and all of this, so they're unrealistic numbers that they're looking at when they look online. Yes. But when they talk to us, we can be like, hey, listen, okay, based on what you're telling me and based on what I'm seeing, you're going to be anywhere between here and here, based on where your monthly payment you want to be and all of that stuff. And then I could send Nini, for example, say, hey, okay, so-and-so is ready to go, and this is the price point that they qualify for. And what you do as a realtor is you would make that list and only allow them to see up to what they qualify for. Because if you show them more, then they're gonna be like, oh, I don't really want that house.
I know.
You can't afford it. And they're like, all right, well then I'm just gonna keep renting.
Yes.
And that's what we don't want. We definitely want people to, achieve home ownership, because when you're a homeowner, statistically your net worth is gonna grow because there's a switch that switches in your mind.
Then you're making monthly payments towards your own investment, your own equity. You're growing your net worth instead of just, hey, I'm paying my landlord so they can grow their net worth and their equity. You're paying yourself, you're paying something towards your own future. And that's what people don't think about. The difference between buying a home and the monthly payments of buying a home and renting, it's not that hard.
It's really not.
It really isn't. Sometimes it's the same or maybe a little more, but it's better to do that and buy yourself a home and pay towards yourself than be giving money away every month.
Because when you rent, you're paying 100% interest. Even if you think interest rates are high now, when you're renting, you're paying 100% interest. So
that's the very first thing I get from any person. Like, how's the market? Do you think it's the right time to buy? And I always answer, the right time to buy is when you're ready to buy, because interest rates really doesn't matter as soon as the monthly payment and the house meets your expectations and your needs. If you can afford to pay the payment and you can get the house you want, that's all that matters. Who cares what the little numbers are? Of course, you want to shop around, get the better terms. Of course, I'm not saying not to do that. But I'm saying that if you need a house now and now it's the right time for you, then it's the right time to buy. The market is going to always fluctuate, always. And people need to understand that this investment is really to themselves and not necessarily against themselves. It's a great way to build wealth for the future.
Agreed.
Right. So the next one is understanding your loan options, and I'll let you just take this one away as well.
Thank you. Yes. So depending on your credit, depending on your situation, there's different programs for different people, essentially. Think of me of like a tailor, like the jacket that you put on is not gonna fit me, for example, you know what I mean? Or vice versa. So it's the same idea. Like there's, down payment assistance for people that need it, and that qualify for it, where they could come to closing with as little as $1,000, out of pocket. And there's people that, are putting 20% down,
Yeah.
So it's very big difference, and it's
Mhm.
going to vary on a per case basis essentially.
Exactly.
Yeah,
A lot of people, I mean, there's so much information online. So
there
people
is.
are very confused. They come in here and they're like, oh, I want that first time home buyer loan that is the FHA. The FHA is not a first time home buyer loan. It is
That is
a
correct.
loan type that is government backed, but it's not a first time only. You can be a second time and still using FHA.
Yeah.
It's just a very popular loan amongst first-time home buyers because it allows for a higher debt-to-income ratio, more debt in general. To summarize, but
Lower, it usually you get an approval with the lower credit score. So if your credit score isn't super strong, you can always go FHA.
exactly,
Um, so that's another reason why people would go the FHA route.
yeah. So that's why talking to a loan officer early in the process of wanting to looking to buy will allow you to understand not just what type of financing might be, like the type of loan option would be best for you, but also any programs, grants that might be available to support your purchase. And then it will give you a better estimation and expectation of, hey, how much money do I really need to get what I want, to be paying monthly what I want, and still be able to afford a home, right?
And
So
how
that's
much do I need for closing? Because also that, for example, FHA will allow you to do 6% seller's assist. So if you're buying a house for say 200,000, and let's say your closing is, your total cash to close, including down payment and all your fees, is say 20,000.
mhm,
Well, you can get 6%. That's 12. That means you only need to bring $8,000 to closing. So
exactly.
it's a big help for people that don't quite have the 20%, and don't want to use it either.
Yeah, and that's the thing too. Maybe you do have the funds, you just don't want to use the funds towards costs and down payment. You want to use the funds towards renovation and furniture, whatever be.
Yeah,
There
absolutely.
are programs available. There's different loan types options that you can choose and pursue to do it because of that reason in particular. So it's not just for people that need assistance; it's for anybody that wants the assistance, right? So
Absolutely, absolutely. Yeah. For example, somebody that say has the 20%, but they want to go FHA or they want to go conventional with only 3% down because they're okay with paying PMI because the rates are high right now. What they
yeah,
can do is they can do a renovation. The renovation gives them instant equity, and when the rates drop, they refinance. They drop the PMI instantly.
instantly. That's a brilliant example there of creative financing and things you can do, but you would need to talk to someone to understand what they are and
Oh yeah, absolutely. Yeah, definitely call us. Don't try to do it by yourself.
exactly. I think I just wanted to explore like the most common ones, just so maybe in general on the surface we can kind of tell people what are the most common loan types that you can possibly see there.
Sure. So you have your FHA, which is going to it's going to be your 3.5% down. It's going to have your higher seller's assist, and you have your conventional loans, which are typically stronger credit, more qualified borrowers overall.
Mhm.
Um, then you have your VAs, which is for veterans, active and, retired and military, and you also have USDA, which is gonna be like your suburbs kind of loans. They're not quite in the city,
Yeah.
but you can finance 100%, and you can also get 6% seller's assist on that. So
Mhm.
you can really come to closing with very little. And then there are the out of the box loans that we can do a whole nother episode about.
One for each. Honestly, yes. There's so many different options out there, but the most common, yes, they would say FHA, VA, USDA, and conventional. One thing to also just clarify to a lot of people: conventional loans are not necessarily always just 20% down. They actually can begin as low as, I think usually I see three, but I think there are some other creative ones that are like
I have
100%.
one that's 1% down.
So yes, it's just no, you can still go conventional. It's just like you said, usually the credit score requirement is a little higher, and your debt to income ratio needs to be usually a little bit lower as well to qualify for those lower down payment conventional loan types. But they are available there. And
Yeah,
then
also, for example, oh, sorry.
uh,
But for example, the other thing about, conventional and FHA is FHA kind of just looks at your number, where conventional is going to look more as your credit profile. how long you had the credit for,
Yeah.
So FHA is a little bit easier to qualify for when, you just started building credit and stuff like that. Your credit isn't necessarily the best. It's got some bumps and bruises. FHA was so
Life
you can
support.
still go FHA. Yes, life happens.
Exactly. Got to start somewhere, or you got to come back up from somewhere. So it's just what it is. And then just to kind of also to let people know, the USDA, for people that are not familiar, it is an agricultural loan type. That's kind of like the description. So it does have a restriction on area of where you can actually purchase at. That if you guys want to ever look it up, you can search USDA eligibility map, and you can find which locations are eligible or not. But basically, no cities, no big cities, anything suburban side that is in the mapping areas. And then it's 100% financing as well. There's some caveats to it. Some caveats to it, but you can talk to Carlos and understand the details, or maybe we can do an episode for that in the next time, and then explain about the 100% financing options available. So I guess that's for that. We did kind of chime in on the next do, which was the save money for a down payment. And we did already kind of say like, hey, yes, you should save. The more you have, the better it is. But you don't necessarily need to save as much as you might think based on the loan type you can qualify for. So I think
Plus, like there's certain for example, if you say you have the 20%, but you're not putting down the 20%, it also makes it. That's also like a compensating factor. So it makes your file stronger. You may have some challenges here, but the fact that you have reserves, the banks is always going to like that.
That's true. That is very true.
To throw that in there, since we kind of covered everything else on this topic.
Actually, writing much more details, so that's awesome. That's good information. Now let's get into the don'ts, and I think that's a very important one. So,
oh man, this is gonna be fun.
Alrighty, so this is a big one because I personally had a deal actually fall through because of this don't that ended up happening. So do not make big purchases before you're closing. Now I'll let you explain why and how that can impact, and what are these specific purchases that you're not supposed to do.
All right, so I've had a few deals fall apart because of this. So. Yes. Okay. So the first thing people need to understand is their DTI, which is debt to income ratio. That's how much you make versus how much you owe. So different loan programs will allow you to up to a certain debt to income ratio. So for example, just to give simple math, let's say on an FHA, your front ratio shouldn't exceed like 45, 46 and a half if you have good credit. So that means for every $1,000 that you make, you can't borrow more than $465 max. Okay. And the front ratio, it's your housing ratio. So that's how much your housing payment is versus how much you make. And then your back end ratio is going to have your housing payment and all of your other debts included. And that on an FHA should not exceed 56.9, but if my managers are listening, it should not exceed 50%.
We have some way around this.
Yeah, absolutely. There's some stretch, that we can kind of play with a little bit. But anyways, so that's the first thing you need to understand is your debt to income ratio, so that I can explain the rest of it.
Yeah.
So when we pre-approve you, we pre-approve you with a certain number, right, of your front end and your back end. Now, when you go out and you get a new loan, for example, let's say and you go under contract and you're like, oh, I want a new car with my new house. So So what happens is that, say we were already pushing your DTI and you were already at a 50%, and then you go out and you get a car payment and your car payment is $600. Well, that $600 could push you over where you had you at the DTI. Number one, that's going to disqualify you right there. Another issue, for example, is let's say your loan is kind of tight, and so we have to be very careful with your rate. So your DTI is also going to determine where your rate is going to be, because based on how much risk the bank is taking is
Mm-hmm.
how much of a cost you're going to have to that rate,
Yeah.
essentially.
Yeah.
So so that's another reason why not to do it. I've had clients who, are 2 weeks before closing, they're like, okay, I think I'm ready to go. I'm gonna go out there now and I'm gonna buy all the furniture for my new house.
Yeah. That's a very common one.
Yes, do not do that. Wait until you close and then go and buy your car and go and buy your furniture so that it doesn't affect your purchase.
Yeah, exactly. Exactly. The other thing that I've had happen too is they thought that they could take a personal loan to cover closing costs. And as you and I know, personal loans are unverified funds. So
Yes.
unless they've been already sitting in your account for at least 2 months, those funds cannot be used at all for anything related to buying a house. Now, if you get this loan after you already got on the contract, then we're even worse situation because it's the same thing you mentioned about the car. It is a loan. There's a monthly payment required. It's going to mess up your DTI again. So just know that's a two no-goes technically because first of all, you cannot even use it. And then second of all, we will mess up your DTI for
That
sure.
is correct.
Yeah. Yeah. So yeah, this is a big one. And I think this is the most common and, people don't think about it because they're excited to buy the new washer and dryer because the house didn't have washer and dryer, and then they go and get it and get a layaway at Lowe's, and then boom, that could mess up if they have a tight DTI already.
Yep.
So no big purchases of any kind. I think the other thing to point it out too, Carlos, and you can explain a little bit further too, is the large sums of cash deposit while you are under contract. Can you
Right.
how that
So
and why is an issue?
right. So depending on the program, it's gonna vary on how much you're allowed to deposit. Let's say in cash into an
Mhm.
account, due to Anti-Money Laundering Act and stuff like that. So I usually tell my clients, hey, listen, once I have them pre-approved, before you do anything, you need to call me. You know what I mean? Like if you're gonna get a gift, there are procedures for you to get the gift. Don't just have your mom go out and pull out $10,000 in cash from her bank, and you go in and drop $10,000 in cash in your bank.
That's a big
Like there's procedures, there's big no-nos. So once I pre-approve somebody, I say, hey, listen, moving forward, anything that's money related, you need to talk to me before you do it. If it's a purchase, I need to know about it, like a big purchase. Like I don't care if you're going to the grocery store. It's like that's not
yes.
really a purchase. But if you need to buy a car, if you need to buy furniture, if you need to do something, you need to contact me before you do that, so that I can tell you if you're okay to do it or you cannot do that. Same thing
Yes.
with deposits. Same thing with gifts. So all of that stuff.
With opening a new credit card.
Yes, same thing with taking unpaid vacations.
Really? That one I did not know.
Yes, because for example, if say somebody is supposed to be 40-hour work employee, and we're gonna keep getting pay stubs every month, every week or every 2 weeks, however their
That makes
pay
sense.
structure is, every time they get paid, we're gonna be getting those pay stubs. And if we see there's variance, in the hourly,
Yeah.
then you have to consider that client a variable employee, and then you have to average the income, and then they might not qualify also.
Yeah. Okay. So that's a huge tip right there. That's a new one for sure. Yeah.
Yeah.
Or maybe an old one, but I'm glad we're bringing it to light. Yeah. Which that kind of, so I since we're talking jobs, second big no-no. Do not change jobs while you're under contract.
Well, do not change jobs before talking to me while you're under
Yeah,
contract.
yeah. Yeah, sure.
Yeah, because let's say you have a job and you're getting paid $15 an hour, and you got a job offer where they're going to pay you $20 an hour, 40 hours a week. Then it makes sense, because that's going to make
Income
it's
high.
going to make you stronger,
Yeah,
essentially. Your DTI is going to be lower. It's going to make you stronger. But we have to make sure, they're going to be a true 40 hours, and that you're not going from commissions to bonus or something weird where you need to have a 2-year history. So that's why I always tell them, like, whenever anything money related, you need to call me. If you're gonna, if you're thinking it's a job switch, call me. If you're thinking gift, call me. If you're thinking buying something, if you go to Macy's and you're buying whatever for $3,000 and they offered you a credit card, don't do it until you call me.
Yes, exactly. And to go back on this one too about the job change, yes, call Carlos first just to confirm. But especially if you're going like independent. So if you're opening a business, if you are, I don't know, like you said, going for commissions or something that's going not to be certain, is not like a W-2 pay stub type of work. That will definitely jeopardize your ability to qualify, because then it's going to require 2 years for them to be able to average your income on that 2-year time frame. And now you're going to have to wait 2 years to buy a house that you were already buying in 30 days. So big on that one.
Always call me, because even though they're telling you you're going to make, $100,000 versus the 70 you were making, what they don't tell you is that, or what you might not realize is that you're only making 40 or 50 in your base pay, and then the rest is going to be in your commissions and all the projected income. But if you don't have a 2-year history of that income, then it's not considered stable income and we can't use it. So It could disqualify you from buying a home.
Yep. And that's not what we want. That's why that's our no-go or don't do it of the list. The next one is don't forget to lock your interest rate. And that's something that I don't think you would have to worry about if you're working with Carlos, because he's going to ensure you're getting your rate locked at the best time. But can you expand on that one, Carlos, for us?
Yeah, so we have different programs and companies that kind of provide us with market updates, 2 to 3 times a day. They let us know whenever the market is going to turn around. So if we're in a good market, I'll be like, hey, listen, this is where the market is. This is where your rate is. If you want, we can lock it today because you're under contract. Or if you want to, ride the market, then we can. And the moment I get an alert to lock, I'm going to call you. Like, hey, listen, this is best case scenario right now. You're, 2 weeks out from closing, or you're 3 weeks out from closing. Odds are you're not going to recover before, you close. You're supposed to close. So then, and some people will be like, no, Carlos, you know what? I know that this is just a slump, and I'm going to ride it out, and I'm going to take the risk, and sometimes it pays off, and sometimes they end up paying more.
True, because we don't know how to. I mean, we can try to predict the market, but it's predictable.
If we could predict the market, I would not be on this podcast right now. Nothing against you, Nini. Nothing against you, Nini, at all.
We can try, I said. I don't know. I didn't say we can do it.
No.
But yeah, nobody can really predict what's going to happen. Yes. So yeah, for sure. Carlos will definitely work with you guys. If you're working with him on this, he will make sure that, by reading what's happening, if that week seems to be like, oh, this is probably going to be the lowest we're going to see, probably, then work with you guys and getting it locked.
This has the potential of being the best you're going to see before you close.
So let's do it. Yeah. So it's good to have an expert that kind of knows a little more and knows how to interpret what's happening in the industry. That way, at least you get the best you possibly could get. Otherwise, by yourself out there, it'd be more challenging.
Absolutely.
Yeah. And then the very last one is really, I think that's what most people do right now. It's assume that they can really not buy when they probably could. And they're rating the market because they're like, oh, the market is not good right now. I'm going to wait it out. Time is money. You know that phrase, time is money. And that is so true. And that doesn't change with any industry, including real estate. I feel like the longer you wait, the chances are it's going to cost you more. And that's just a fact. I mean, historically, we have not seen anything that just doesn't stop going up unless there is a crisis like the 2008 crash. Not the 2020 crash, because there was no crash and the market just kind of, but you know what I mean? So unless there's something out of the norm, the expectation is that's going to continue rising. And the longer you wait, the more costly it's going to be for you. So don't assume.
It's always better to buy now. If you can, of course, if you qualify, it's better to buy now, because if not, you're gonna keep paying rent, and rent is 100%, even if the rate is 7% or 8%, wherever you land,
Yeah.
which we're not at 8 anymore, thankfully. We're
Yeah.
in the, we're lower than that, but yeah, it's always better to buy now because you're paying 100% on your rent, essentially.
Yeah.
And if you wait, you're gonna miss out on the equity that you're building up, because if you're buying now, you're buying somewhat, I don't know, better, I would say, because the rates are higher and there's not that many people out shopping. The moment the rates go down, a lot more people are going to want to buy, and then your prices are going to go up.
And then you're going to be the worst terms that you can possibly have to purchase too, because from experience, if the rates do happen to drop to a significant change, and then you have tons of buyers coming into the market, like you said, fighting for one house that is in the market.
Mhm.
Now what you have is you're going to be overpaying on that one house, because people are going to be overbidding. You're going to have to eliminate some of your rights of, like, maybe I want to do a home inspection, maybe I want to negotiate repairs, because now you're putting yourself in a bidding war where you have to basically waive everything in order to even get the offer.
Offer more than they're asking for the house, and be willing to cover it if the house doesn't appraise, which happened a lot in 2020.
It happened all the time in 2020. Appraisal gap or full-blown appraisal waiver was all over the place back in the day. It was scary to me, as like working with buyers, to even recommend that, but they wanted the house and that was the only way to get it. So it was kind of like a crazy time that I hope we never see that again. Let's hope that we get to a balanced market where your buyers can still shop and can still somewhat negotiate, sellers still have buyers coming in, so like a balanced market. And we have yet to see that. We're still technically in a seller's market. We still have way more buyers than we have houses for sale. So I think our months of inventory for most of the counties here in South Central PA are no more than 2. They're usually 1 point something. So that means if no new houses came in the market today, we would only have about a month or so of inventory left over, which is a very low inventory overall. We are getting better. We're seeing a progression from previous years, but it's still not balanced whatsoever. We would love to see between 3 to 4 months of inventory available, which means buyers would have a little more a better standing, right?
More negotiating power when it comes to that aspect. Yeah,
we are seeing that. We're definitely seeing that, especially winter season. Like, real estate market is seasonal. You don't want to wait too long, but you also, depending on the season, there are seasons that it might be better for you or not. Some people prefer to buy during the winter time because there's less buyers buying during the winter time, but also there's less houses. So if you can find something you like, great, but if you can't, you might have to wait for spring because there's more houses, but then you also have more buyers. So it's and it depends on your situation.
It's a give and take.
And if you're trying to get in for school, it depends on everybody's ideas and goals and what they're trying to achieve there. So I think that's our last don't. Can you think of anything else that you think like, oh, this one's a big no?
Yeah, I'll add one in.
Go for it.
Don't think I will not find out. Tell me everything up front. It's better you tell me when we start the process than if I find out when we're 2 weeks away from closing. So I will find out.
Potential priest, gotta come clean, like.
Yes. Tell me everything, so that we're not surprised together.
That is so true. Yeah, and it's better to come clean up front so that you can better prepare and help them better than finding out afterwards when we're already in the contract and then end up losing a house, right?
Yes.
And
that happened a few times.
Yeah, we don't want to be in that situation. There's no fun for anybody, everybody that's doing the work, the buyer himself or herself that, fell in love with that property. Now, boom, maybe cannot.
Yeah, absolutely. Because we really do want to help people, get into the home. I mean, it is a dream, and here in the United States, you know what I mean? Like, how many, it's incredible. Like when you're talking to somebody and they're like, oh my God, I can actually buy a home. Like I thought I needed 20%.
I
I
know
thought I needed a 740 credit score. You
that's the best
know,
feeling. Yeah.
I thought I needed to be at my same job for 2 years, and that's not always the case. There's different workarounds and stuff, you
Yeah.
know. So, it does hurt when you're not able to close because you didn't tell me something and thought I would never find out.
Yeah, and sometimes it's something silly that you could have
It
taken care of
is.
ahead of time, and then it's too late, and we're in a bad
It
situation.
is.
Yeah.
I had a client. I won't get into any specifics, but I had a client who did not tell me something, and I think like maybe a week and a half before closing, the surprise came out. Surprise! And then that deal, of course, fell apart, and we were able to pivot, and we were able to get the loan done, the next month, on another property. Of course, they lost that property, but they were able
Yeah,
to find another property, and we were able to get the loan done.
that's good. I'm glad that at least it worked out, but they end
Yeah,
up that first one, and that's definitely never fun.
yeah.
Once a person falls in love with a house, I know how difficult it is to, find a second one. Uh,
Hmm.
so we want to avoid that if possible. So going back to that first do that we mentioned, that is work with a trusted loan officer from the beginning. Yes, that's when you should be telling everything. Everything
Yes.
finance related in your life should be, told to Carlos ahead of time so he can really, really work with you on getting ready and solving any issues that might be needing solving way before it becomes a problem.
Yes.
Yeah.
Yes. And if you're not ready because of that issue, we can prepare you so that you are ready down the line once that's no longer an issue.
Yeah, yeah, and it could be quicker or sooner than they think. Sometimes much sooner than they think.
Yeah.
Someone coming in saying, "I have terrible credit," and in fact, they don't even have a credit, which is in the best position to be.
Yeah, absolutely. Yeah.
We were just talking about different client, but yes, that's fun
Yes.
when you have a client. They're like, "Oh, I have poor credit," and then they just don't have credit, which is good.
Yeah.
We
It's
can
an
build.
easy fix, and it's not as bad as people think.
Yeah, exactly. Well, I think that's it for today. This, I think, was a very successful comeback episode, which I'm super excited now. You guys are going to be seeing more of us here in the next couple weeks. So just stay tuned, and we'll be seeing you next. Thank you so much, Carlos.
Till next time.
Until next time.